So I'm out here in the Salt Flats doing a little reconnaissance mission, trying to find if someone can actually explain what the heck is actually going on with all these tariffs. Spoiler alert, no luck. In just the last few weeks, we've seen policy whiplash, market turbulence, bond yields were creeping higher, and plenty of panicked headlines. And I get it. If you're closing in on retirement, or maybe you're already in it, it can feel like the emergency lights are flashing all over the place. So let's not do what the media is doing. We're not going to try to predict what happens next. Instead, we're going to focus on what you can actually do right now. Because the most successful retirees, they don't try to control the markets, they control their next move. So let's talk about what those next moves are. But first, I'm Steve Willems, a certified financial planner and wealth advisor with the Willems Wealth Planning Group up in BC. We started this channel to help people plan and arrange their investments, their income streams, and ideally pay less tax along the way as they prepare for retirement. So let's start with the obvious. The last few weeks have been quite something. This whole thing was concocted based on a fundamental misunderstanding of how the global economy works. It seems the US administration thinks that manufacturing job time soon. They believe that they're going to start building microwaves and pencils right back in America. That's just not happening. Now, they think that free trade made them poor, when in reality, it's been one of the greatest engines for their prosperity. They panicked about their current account deficit when it's largely just a rounding error against their aggregate net worth. They somehow view being the global reserve currency as a bad thing, when it's really just a signal that the world wants to do business in US dollars. And they frame themselves as victims on the world stage, despite being the richest economy in human history. So in their opinion, what was the fix to all of this? Well, they said it was going to be tariffs, a policy that almost every single economist, whether you're on the left, the right, or right down the middle, thinks is a really dumb idea. And worse still, the math behind these tariffs was wildly off. The initial numbers were so irrational that they had to backpedal, and when the bond yields reacted because a bunch of international countries, including Canada, started selling them off and pushing those prices up, they panicked again and made some surface level adjustments, kind of declared victory because stocks rebounded within that same day, intraday. Meanwhile, the structural kind of economic risks that they triggered through this whole episode, those are still there and they're still growing. Now, I'm not here to dunk on American policy for sport, but when global markets move, Canadians feel it too, and especially those retirees or those near retirees trying to make smart withdrawal decisions in volatile times. Now, you and I can't control tariffs. We can't control interest rates. We can't control who's in charge south of the border. And thankfully, businesses go on every single day trying to solve problems in spite of all of this. But you and I can control the plan. And when markets shake, the people who stay calm aren't the ones making predictions. They're the ones who know what they own and why. So here are a few things that you can do right now. Practical, maybe boring, but certainly effective. The first is just knowing what you own. It sounds simple, but most people don't actually have clarity here. So ask yourself, how much of my portfolio is in equities and stocks? Number two, how much of that exposure is in US stocks versus international stocks or Canadian stocks? So far this year, there's been a massive spread of performance between these different geographies, even within equities, within stocks themselves. So this matters now, especially. And third, how much of this money do you actually need to draw on in the next few years? If the answer to any of these is I'm not sure, then this is going to be your first place to start. Because when markets drop and headlines scream, your ability to zoom out depends entirely on understanding your buckets. Right? If you need $60,000 a year to live and you've got 3 years of cash set aside, or maybe short-term fixed income instruments set aside, that's great. Hey, that's runway. You don't need the equities right now, so let them do their job over time. But if you've been winging it, maybe pulling cash ad hoc from wherever, volatility is going to feel a lot different for you. Or if you have a concentrated portfolio where the names are kind of moving around in wild 20% daily swings, this feels urgent. And in some cases, it might actually be urgent. In other cases, you might actually be well set up, right? Well diversified broadly to weather through this however long it lasts. So that's number one. And number two is controlling the controllables. It doesn't feel good to do nothing in a market downturn, so don't. Find your, what I would call, a small locus of control. Now for you, this could mean a few things. It could mean tax loss harvesting in your non-registered accounts. It could mean triggering a loss and carrying it back to offset prior year gains. It could mean pulling a bit more from your RIF this year and using that to top up your TFSA. Maybe it means gifting money to your kids a little bit earlier to shift that future growth into their lower marginal tax brackets. Or maybe that big ticket item gets rounded down or maybe pushed off just a little, right? Not indefinitely, but maybe just until things stabilize a bit. Now, none of these things are flashy, but they're all going to quietly improve your plan's efficiency, and they're all going to make use of this market turbulence without reacting emotionally to it. Now, the third is just to run a plan refresh. This one's often overlooked, but it's critical and it's something that we do all the time. Volatility here isn't the problem, but unexamined volatility is. So 2 things I'd recommend. Number 1, run a minimum rate of return analysis. Look at your last financial plan and ask, how much return do I actually need to earn to achieve my long-term goals? For some clients of ours, it's 0%. They literally could bury their money in a dirt bag and come back to it, and they just don't need the money to earn a positive return for them. For other people, it's much, much closer. And knowing what your number is going to give you a sense of how exposed you might be when volatility like this comes and erupts in our faces. Now, the second thing is going to be running a sequence of return tests. Now, this is going to ask the question, what happens to your plan if markets are maybe flat or down in the early years of your retirement? Is it going to affect things long term? And this is going to help you make much better decisions today as it relates to your current spending. Now, both of these can show you on paper whether the plan still works, even if the markets don't behave for a few years. And once you've seen that, you're going to be less likely to abandon the plan the next time the headlines get loud. Now, the fourth and final thing is just what I would say is writing your protocol. Now, what do I mean by that? Well, this one's personal and it's powerful, but it has nothing to do with money. Now, naturally, all of this noise and turmoil can lead to stressful thoughts. And when we park ourselves on those thoughts, some of us can start to spiral. And if that happens, it tends to manifest itself in very bad and unhelpful behavior. For some, it might be panic selling. For others, it's doom scrolling. Now, we need a plan to catch ourselves before that spiral starts. So for me, when I feel that anxiety building, I get outside and I go for a walk. I give it maybe 8 to 10 minutes, and that frustration, that negative mental loop, it gradually fades every single time. There's something about the distance, being outside, that gives me space to think again. And that's what I'd encourage you to do. Write down your market stress protocol. What's your version of getting outside? Who should you talk to in that moment? And what don't you want to do? Because anxiety isn't actually the problem. Acting on it is. As Viktor Frankl famously said, between stimulus and response, there is a space. And in that space is our power to choose. A protocol like this kind of protects that space from you and I doing really dumb, stupid things that we'd otherwise regret. Now, hey, look, the headlines, they're not going to slow down. And let's be honest, whatever today's story is, it won't be the last one. There's always going to be noise. There's always going to be these policy shifts and market moves that you can't predict or control. But here's the good news. You don't need to predict the future to plan for it. You need a structure. You need clarity. And when things feel uncertain, you need a small set of actions that you can come back to consistently to put you back in control. And if you're looking at your plan right now and you're wondering, hey, am I still on track? What should I be actually doing when all of this is going on? If you feel like you need a second set of eyes to double check that, we'd be happy to help. I'll leave a link if you'd like to connect in the description below. You can grab a time on my calendar and we'll take a look at what's going on in your world. And wherever you're watching this from, take a deep breath. Maybe go for a walk and keep your hands off that panic button. Hey, thanks for watching. I'll see you in the next video.